We're live. Good morning. I'm Chuck Bunch, and welcome to our first PPG truly global employee meeting with our new webcast technology. We hope this is going to be the first of a number of opportunities that we're going to have to be able to reach out, talk to you about our company, and have a live interactive Q&A session. We are experimenting with our new technology. So would you go to the second slide, Roger? No, backwards, please. Okay, this is a brief agenda for us. I'm going to start with some remarks about our economic conditions globally for PPG, our strategy for leadership and success in these markets, and then Bill Hernandez, our Chief Financial Officer, will come up and give you a review of our first half financial performance. And then I'll join Bill here at the podium. We'll answer some questions that have already been submitted by you by email, and then we'll have an opportunity to also have people either here in the audience or at all of the locations ask questions that we will respond to. We have about an hour. And I'm looking forward not only to the opportunity to talk to you about it, but also to interact and to talk about the things that are on your mind. If we look at 2006, this has been, to date, a very good year. A lot of positive economic news. The global economic growth continues, both here in the United States, but also in China and in Asia in general. We have also seen globally strong construction market growth, and world automotive production is growing. Stable here in North America and Western Europe, but certainly growing in the emerging regions such as Eastern Europe, Asia, and in particular China and now India. The dollar this year has remained stable, but we do have some economic concerns or negative impacts on our markets. One is energy and raw material costs remain high. We are also seeing here in North America a slowing that we anticipate in the second half in industrial production growth. The U.S. residential housing market is also starting to weaken, and competitive and margin pressures for PPG remain intense. One of the biggest factors over the last few years affecting our markets on a global basis is what we refer to as the increasing globalization of the world economy. Probably the biggest factor here in globalization has been the growth and emergence of China. You see here in 2005 they had GDP growth of 9%. This is 3 times the growth rate that we've experienced here in the U.S., and they have been at this rate of growth for the last 3 or 4 years. You also see industrial production growth last year in China, 16%, and this is an indication of their emergence as a manufacturing powerhouse that they have also used not only to grow their domestic market, but to become a real export threat for many of the established regions, including here in North America and Western Europe, and affecting many of the products that we manufacture. One of the other impacts that we're seeing this year and have been seeing for the past 3 or 4 years is the continued escalation of energy costs. We're all aware of what's happened in the global oil markets. And here in North America, we have seen an escalation in our natural gas costs, which are an important energy component for our businesses here in North America, like ChlorAlkali and glass and fiberglass. As you can see here, costs have gone up to about $8 an MMBTU last year from levels below $4 as recently as 2002. In 2006, through the first half, the costs have actually averaged a little higher than last year, although we've seen some moderation over the last few months. But if you look at the overall cost impact of this escalation on PPG, it's $250 to $300 million, the impact of the last 3 years in natural gas costs alone. And if you think about our reported profits last year of about a little over $1.2 billion at an operating level, we're talking about a 25% increase in costs versus what we have historically made in our company on a global basis. We have also seen an escalation in what we call legacy costs. These are pension, OPEB, which is other post-employment benefits, more commonly known as retiree medical, and healthcare costs. These are affecting us primarily in North America, but you can see the escalation over the last 4 or 5 years. So we've gone from about $100 million of costs in these areas 5 years ago to now over $400 million last year. And if you combine that with the energy discussion we just had, this is $600 million just with those two cost elements alone, which is half of our operating profit last year. Now, taking a step back and looking more broadly at where PPG sits in what we call our supply chain or value chain, this is, I think, one of the more interesting slides. This shows the market capitalization or size on the x-axis or left-hand side, and the companies in our value chain here along the bottom. So that what it shows you is PPG is positioned here in the middle as what I would call an intermediate manufacturer. So typically in almost all of our businesses, whether they be chemicals, coatings, or glass, we are buying products from our suppliers or energy or chemical raw materials from industrial giants like ExxonMobil, Shell, BASF, Dow, and DuPont, and then we're in turn processing these materials and selling them to the customers along the right side of the equation. These are large automotive companies like Daimler, Chrysler, or Toyota, or General Motors, or big retailers like Lowe's or Walmart. So I think this slide illustrates how we occupy a small niche position in the middle of our supply or value chain, buying from very strong, powerful suppliers and then selling in turn to industrial or retail giants. And so that our economic power in times like this, when you're under pressure from increasing costs, has been limited. What's been the reaction in the marketplace to these trends? And I think one of the things that we've seen is increasing consolidation in our markets. And these are descriptions of encoding some of the acquisitions and merger activity that we've seen. And these are attempts on the part of our customers and ourselves to position ourselves with a little stronger position, gain a little more leverage against these giant suppliers and customers in which we're dealing with in the value chain. So that you can see in almost every competitive market or industry that we're competing in, we have competitors that are now combining to strengthen their position and be better able to compete not only with us, but to supply these increasingly large and demanding customers. What you've seen here in the last year as we have stepped up our acquisition activity, we too have now engaged to try and strengthen our position in each one of these businesses. So you've seen last year a couple of smaller coatings acquisitions, and then recently we've increased that activity with Amaron, Dongju, Spectratone, Protec. In chemicals is specifically optical, International Polarizer, and Intercast, trying to improve our ability to deliver products and services to these large customers. and glass and fiberglass with our cinema joint venture in China or our Iowa glass distribution activity or acquisition, again, trying to improve our position in this consolidating marketplace. How are these trends then evidencing themselves, and what is our response needed here? I think what we've seen, obviously, increasing pricing and margin pressure as we've tried to move the cost increases that we've absorbed onto our customers. What do we need to do here? Increase our productivity, watch our cost management, take pricing strategies that will enable us to pass some of these increases onto our customers who for many years have not been used to us trying to gain additional prices, where in the past 20 years or so we've had relatively benign commodity markets in many cases. Now that we're seeing all this cost escalation, we have to be once again able to pass these increases on to our customers. We're also working hard at developing networks with our customers, helping to make them more successful, better able to penetrate in their markets, grow so that we can grow with them. We're also seeing in some cases where we feel we have a cost disadvantage, we're aggressively trying to manage our costs and focusing on innovation, trying to sell higher value added products and not just trying to compete in the commodity segments of many of our markets. As we've seen what we call demand migration, and some of this is our customers then also moving to the emerging regions to manufacture their products, we are trying to improve our position here in emerging regions so that we can service these customers whether they're in China, in North America, or anywhere around the world. In the financial markets, I think this is an important backdrop for us. I think we've seen over the last 5 or 10 years an increasing sophistication in financial markets, more choices for investors, growing power of some other financial players, and that's produced, I think, an increased emphasis on short-term results on the part of our shareholders and many investors. They are no longer as patient for a longer-term strategy and a payoff down the road. They would like to see progress more quickly, greater accountability for management and for our board of directors, and execution on the strategies that you've identified is critical. If the investors don't feel that you're making progress and executing on your strategies, they will move on, and they have the opportunities and the choices to do that. If you look at our strategy now in this challenging environment, I think we have 3 things that we'd like to focus on: leadership, growth, and innovation. In leadership, our vision has been to become the leading coatings and specialty products and services company. We want to be an integrated, market-oriented enterprise dedicated to serving the needs of our customers. And our customers, despite all this discussion about what's going on in the global environment, we still have to maintain that important focus on our customers, and we must lead in the markets and technologies in which we compete. We aim to achieve sales and earnings growth of over 10% a year. This is an ambitious target, and we're going to maintain the same strong culture, the same blueprint values that we have always had here at PPG. We value our people. We have a safe, harassment-free workplace, reward diversity, teamwork, performance, and we value our communities and our roles there with sound E&H practices and a good communication and dialogue with our communities and neighbors. If we look now at leadership in our cash generation businesses, we are trying to now drive for the lowest cost position, and we will selectively invest for renewal in these businesses. And I think you've seen over the last year from us 3 big projects, including the ones here, where we have made significant commitments of capital to our mature cash generator businesses. One of the most exciting for me was the Wichita Falls glass coater, the largest investment that we've made in the glass business in over 10 years. We have great technology, that meets these demands for energy efficient glass, and a great opportunity for us. We have announced a conversion to membrane cell technology at our Lake Charles, Louisiana plant. Again, the largest investment we've made in ChlorAlkali in well over 10 years. And the recent announcement of our fiberglass joint venture in China with Cinema is another indication of investment for renewal of these critical businesses. You've also seen us step up our acquisition activity. We have targeted emerging regions of the announcements that you've seen over the last year. Shanghai Sunpool, which is Chinese architectural coatings. Crown Coatings, which is industrial coatings in Singapore. And the remaining interest in PPG Dongju in Korea. This is primarily an automotive and industrial company, but a critical part of our supply chain growth in Asia Pacific. We've also made more acquisitions in coatings. Two companies earlier this year, Iowa Paint, now recently Spectratome, adding some 64 paint stores or service centers to our growing network this year. We also completed an acquisition this month of Amaron Performance Coatings, which is our first entry into the marine coating segment, and also builds on our existing position in high performance and protective coatings, a critical global acquisition for us. And most recently, Protec, an excellent small company in Australia focused on the fleet segment of our refinish business. Few more acquisition stories. Obviously, we're continuing to build on what we feel is one of our most successful businesses, optical products. We just opened a plant in Thailand. Last year, we completed an acquisition of International Polarizer, an important purveyor of technology in the sun lens market in optical. And we have moved selectively down the value chain in our markets. Two good examples. One, a startup or organic growth, All-Tech Engineered Finishes, which are where we're actually coating screws and fasteners in a new plant that we have built in Taiwan, and our recent acquisition in optical of Intercast, which is an important manufacturer of sun lenses, and this is our first foray down the value chain into actually supplying or manufacturing lenses. We're also continuing to work hard on organic growth. We're better leveraging, I think, our cross-SBU synergies. The construction market team is one of our best examples of getting all of our businesses that are supplying products and services into the commercial construction market to work together to effectively market our products to architects, designers, engineers, and specifiers. And we also have another example in our light industrial coatings where we're working through both industrial refinish and architectural distribution networks to penetrate this important segment of growth for us in this area. We've talked a little bit about innovation. This is an important part of our story to sell value-added products, important part of our R&D portfolio. We are working on providing more innovative products and services and solutions to our customers. We've identified 4 mega trends: energy efficiency, environmentally friendly products, comfort, and security as key areas in which we feel that we need to develop products for our customers and their consumers. And if we do this successfully, we will be well positioned to supply truly innovative, value-added products that will return to us higher margins and get us out of some of the competitive commodity fray. So if I can conclude before we bring Bill up, 2006, we're off to a very good start, appears to be a good year. It is still very difficult in this environment to improve our margins. It's critical that we maintain our focus on cost and productivity improvement. We need to continue to grow and position our company in emerging regions. Innovation will still be the foundation of organic growth and success, and it's fundamental to our future. And new challenges offer new opportunities. Despite the difficulties, we can't be afraid of the future or the challenges. We have a great company. We've been successful for almost 125 years, and we have all the resources that we need to be successful and to overcome these challenges and to actually benefit by solving these problems, overcoming these challenges more successfully than our competitors. So let's not be afraid of the difficulties, and let's not be afraid of the future, and let's continue to work together to deliver the kinds of products and services in the market. So with that, I'll bring up Bill Hernandez, our Chief Financial Officer.
Thanks, Chuck. I want to talk about some of the numbers we have been able to achieve so far this year. And the first numbers I'd like to focus on are safety, and I think we've done a really good job so far this year. If you take a look at our safety performance so far this year, we had a goal of reducing our injury and illness rate to 0.81% for the year. And you can see the downward trend we've been able to achieve over the last several years. Well, year to date, we're down to 0.75, as 9 out of our 15 business units actually are running ahead of their rate from last year. And 3 units in special, I'd like to count, is really achieving some really substantial results. Fiberglass is down a third in terms of their injury and illness rate. ARG is over 40% down from where they were last year. And automotive coatings, who is already at one of the lowest rates within the company at 0.54, has dropped to 0.35 injury rate, down over 45%. So I think we've really shown some really good performance in terms of safety. Taking a look at the financial results we've had for the first half of the year, its sales of just under $5.5 billion. Those were all-time record sales for both the first and second quarter. In fact, the second quarter achieved the 13th consecutive quarter of year-over-year quarterly sales records. I mean, really great performance. It's over 3 years that we've generated quarterly sales records. If you take a look at our performance versus last year, we're up over 6% in terms of sales, over $300 million versus last year. And our earnings are up $50 million, or about 40 cents a share over where we were last year. Large reason for the increases, sales and pricing are higher than they were last year. Acquisitions helped us a bit. And in terms of earnings, the sales performance more than offset a lot of the inflationary impacts that Chuck has been talking to you about in his comments. And we've also seen some good manufacturing improvements. We've also seen some improvements actually in our tax position. We have a very good relationship and have done a good job in terms of settling a lot of prior year tax issues with both the Canadian and the U.S. governments, and that's helped our performance also in the first half of the year. Now, if you take a look at it by business units, you can see coatings achieved sales of just over $3 billion for the first half of the year, and every business unit within coatings did report year-over-year sales increases. Chemicals is up to almost $1.3 billion, about $35 million better than last year, and that's primarily due to very strong volume growth in optical, good pricing in ChlorAlkali, though ChlorAlkali volume is down. Glass is up about $40 million versus last year, and that's primarily in performance glazings. And in both price and volume looking quite a bit better. And fiberglass is about even with what their sales were last year. Now, if you take a look at profits, you can see coatings is up about $77 million over last year, at about $450 million of profit. As I said, the good price, good volume occurred in coatings. They had a lot of raw material increases, but they were much able to offset all that, as well as the manufacturing efficiencies. Now, chemicals, glass, and fiberglass, you can see all three of those business units are down about $49 million from where they were last year. And I'd like to just touch on what some of the reasons for that are. If you take a look at that $49 million, it breaks down into a lot of causal factors. The largest is the one Chuck mentioned, natural gas. Natural gas, last year we paid in the first half of the year $6.60 per million BTU. First half of this year we paid $8.60 per million BTU. That's $66 million more it cost us to run our ChlorAlkali and our silicas and our glass businesses, which are our big energy users within the company. Now, if you look at price, we were able to achieve a good amount of price, and price by itself offset the inflationary increases that occurred if you just included natural gas. But there are a lot of other inflationary pressures within these businesses, and a lot of them are also energy related. Raw materials are about a third of that total, and that's primarily soda ash and ethylene. Ethylene is a big user of natural gas and drives that up quite a bit. Electricity is up, freight is up. Again, energy, a major part of that. And a little over a third of the cost is due to other inflationary increases, which are mainly salary increases and benefit cost increases. Now, the $60 million is about two-thirds offset by manufacturing efficiencies and cost reductions as we improved yields and did a very good job on those aspects, but it did not offset all those other inflationary increases. Volume and mix are down about $10 million, and environmental costs are up over $20 million versus what they were last year. Last year, we spent $6 million in the first half of the year on environmental costs. This year, we spent $27 million. And it's primarily related to one issue, to the manufacturing of a product that PPG actually made in the early 1950s and stopped production of in the early 1960s in New Jersey, which was chrome. And I'll talk a little bit about that later, but it's an old issue, and as Chuck mentioned, sometimes legacy issues come to the fore over a course of years, and that cost us $20 million in this first half of the year. Chuck mentioned the growth that we are trying to push for the company. And I think what's important is that the target that we have to grow the businesses, and just taking a look at 10% margin growth, and as I said, we grew 6% in the first half of the year. So just trying to show who grew the fastest. If we take a look at the companies that were able to achieve at least 5% sales growth, or close to the 6% growth that we had in the first half of the year, and did improve PTPI by 10%. We had 6 businesses: optical products, aerospace, performance glazings, industrial coatings, silicas, and packaging coatings. We also had another 6 businesses within the company that achieved at least one of those 2 targets, so that they may be able to rise up in the last half of the year. And we had 3 businesses that weren't able to achieve either, and that was Fiberglass, our OEM glass business, and our fine chemical businesses. Now, Chuck also mentioned a lot of our growth is coming not only from organic growth, but what we're doing in the emerging regions of the world and acquisitions. Let me show you some of our performance in those areas. We've made 10 acquisitions so far this year, and about $270 million of cash has gone out for those acquisitions. We expect in this year that they will add more than what we paid for them, about $300 million in terms of sales. And on a full year basis, if we were able to fully incorporate them for next year, they should add about $600 million in total sales for us. And we continue to evaluate potential acquisition candidates as we go through this year and into next year. If we look at the emerging regions of the world, and that includes not only China, which, as Chuck mentioned, is so rapidly growing, but the Middle East, areas like Eastern Europe, Russia, and Latin America, you can see at the moment it's about 12.5% of total PPG sales. And as we said, PPG grew at a 6% rate overall. Those year-to-date growth rates in the emerging regions were 19% of our total. The same as Chuck showed you for industrial production that was happening in China, a very good growth rate. And as we're putting investments in getting ready for future growth there, you can see the margins we earn in those emerging regions are very close to our corporate average. And one of the things I want to talk about also is cash. And PPG is very well known within the investment community as a company that generates good cash, and we generate it in bad years as well as good years. And you can see over the last 10 years, average about $1 billion of cash a year. And if you go back to the year 2001, which was a recession year, we actually generated a little higher than we did in either the pre or post-year period. So we are a company that's well known for generating good amounts of cash by the blend and the portfolio of businesses we have. So I want to show you what we do with that cash and what the demands on cash are. And the first use of cash we always look at for this company is reinvesting within the company. And reinvesting within the company for organic growth as well as making acquisitions. I showed you the slide that showed we've spent $269 million so far this year in terms of acquisitions. Well, in terms of just normal capital spending, we expect to spend about $400 million this year in terms of capital spending. We spend roughly 3.5% to 4% of sales on that, so $350 to $400 million is a normal kind of capital rate that we need to spend within the company. We also pay dividends, and I'll show you another slide on dividends, but dividends over the last 5 years have averaged just roughly $300 million a year, and we expect to continue paying that. We expect to maintain a well-funded pension plan. We haven't had put money in the pension plan for many years. This year we're going to put $100 million in probably in the next week or two into our pension plan. And we make sure we manage our debt very conservatively within the company. If you look at what we have done over the last 5 years, we've paid down debt at the rate of about $300 million a year. Where we are now, we're in a great debt position. We have no debt that we need to worry about paying for the next several years. So a great opportunity for growth position. And the remaining cash that we use to repurchase shares. And over the last 5 years, that's averaged just a little over $100 to $150 million per year. So far this year, we've only spent less than $20 million in terms of share repurchases. Now, when I mentioned capital expenditures, and it's going to be around about 350 to 400 million, as I said, it's about 3.5% of sales. And I think a real tribute to the people in PPG is the way they had brought down the reinvestment rate in terms of capital for the company. Some businesses we've gone into are less capital intensive, but we've done a very good job in every business we have in both lengthening the life of assets as well as being very prudent on how we spend capital, spending the appropriate amount. And if you just went back to the year 2000, we were still spending that rate at the sales kind of level of $10 billion company we were last year, we'd be spending more like $500 million for capital. If we went back to 1990, we'd be spending almost all of the cash we generate in capital. So we've done a very good job, I think, in managing our capital as we've gone forward. I mentioned dividends, and dividends is a critical part of how PPG is viewed by an awful lot of our shareholders. And the important thing is PPG has now increased its dividend every year for 34 straight years. But the point up in the corner that I'd really draw your attention to is that PPG has paid a dividend every year since 1899. Chuck mentioned we're a 125-year-old company. There are only 5 companies, you can count them on one hand, that have paid a dividend and never missed a dividend since the 1800s, and PPG is one of them. So I think you should be really proud to be part of a company that can claim that. Now, those are some of the good things, and cash is important, and we manage things conservatively, but the other thing we think very conservatively is our environmental stewardship within the company. But we are an old company, and there are lots of legacy issues. If you take the company over the last 15 years, we have spent on the average $10 to $49 million in historical annual expense for environmental costs. I mentioned earlier we spent $27 million just so far in the first half of this year. Well, back in 1994, we took a look and put in our financial statements and disclosed to the outside world what were reasonably possible environmental exposures for the entire company. And again, dealing with very old issues. And at that point in time, we estimated $200 to $400 million as a reasonably possible environmental expense. That number has not changed since 1994. We still have that in our current financial statements. It really relates just to a couple major issues that date back a long period of time. It relates to environmental costs within and surrounding the Lake Charles ChlorAlkali plant, and it relates to this New Jersey chrome issue that I mentioned that we produced for a short period of time from the early 1950s to the early 1960s. That's what we spent some money on, and that's the primary part of that environmental exposure, and something that we'll continue looking at very closely over time. Chuck mentioned natural gas, and I just thought I'd show you a quick graph of where we were in the first quarter of 2002 when gas was closer to $2, and as it spiked during the cold winter months and due to the hurricane activity that happened late last year. And if you actually look at what natural gas has cost PPG, in 2005, natural gas cost the company an extra $150 million in total costs over 2004. And if you look at what it cost over 2003, for 2004, that was another $80 million, so $230 million, almost over $250 million increase in natural gas just in those couple of years. We try and manage it as well as we can in terms of hedging, but if you look at the total bill for natural gas last year was $600 million that we spent for a company. Now, the cost per million BTU, which is on the y-axis over there, for every dollar change in that, up or down, it costs or helps PPG by about $70 million. So you can see the exposure the total company has simply to natural gas. Yes. Another place we have a lot of exposure to is ChlorAlkali. ChlorAlkali is doing very, very well at the moment. It's actually very close to the peak earning year it had back in 1995. But you can see ChlorAlkali is the most cyclical business we have within PPG. And it's basically has been almost on a 10-year kind of cycle, where we had in the early mid-1980s a peak, we had a 1995 peak, and we probably has had a peak in 2005. But you can see how rapidly it can drop. You have a slow deceleration, then a rapid. In 2002, we barely made any money at all in ChlorAlkali. So you can see the exposure we have in ChlorAlkali. Now, the advantage often happens when ChlorAlkali pricing drops, the rest of our raw materials drop in coatings, and coatings margins expand. So we have a little bit of a natural offset, but it is our most cyclical business. Another business that's had a lot of pressure on it this year and over the last several years are our glass and fiberglass businesses. From 2001 to 2005, they've dropped $150 million in terms of total profit in those businesses. And one of the biggest changes has been price. The competitive pressure, the market forces have really driven weaker pricing, and we've lost $225 million in pricing just in those 5-year period. Gas, also I mentioned, is a huge impact. Gas, glass and fiberglass, after ChlorAlkali, are our biggest gas users. Energy has cost them, and that plus other inflation, $238 million over that 5-year period. Now they've offset that quite a bit by reducing operating costs by about $280 million, but not enough to offset both of those huge cost increases that have occurred over the last, cost increases and price decreases that have occurred. If you take a look at where the impact of all this that have happened, it's caused PPG over the last 10 years. 10 years ago, PPG was about a $7 billion company. Roughly we're going to be about an $11 billion company. So in that period of time, we've kind of changed a little mix of the pie. Chemicals is roughly the same size as it was 10 years ago, just under a quarter of our total sales. 10 years ago, as I mentioned, ChlorAlkali was at a peak, so that's roughly comparable. But the great volume growth we've seen and price growth we've seen in optical has really also helped keep chemicals roughly to the same level. The major shift that we've seen over the last 10 years due to those difficult pricing arrangements that have occurred in glass has caused glass to drop from a little under 40% of the company to about 20% of the total revenues for the company, and coatings to expand from under 40 to 56%. Now within coatings, the one aspect that has improved this year is our margins, and that's happened as we've been able to get better pricing and much more offsetting raw materials than what we had in the prior year. If you go back to 2004, coatings had about a 15.5% profit margin. It dropped a full 2 points in 2005 to 13.5% as the raw material escalation got pushed an awful lot by energy prices, and we weren't able to recover pricing. Through 2006, we're back up to about 14.5%. So we're just about a point behind where we were in 2004, and we should see that continue increasing. Now, before Chuck comes back up, there is one last thing I'd like to mention, simply because a lot of companies are in the news in terms of their financial reporting. And if you look at, and if you read the newspaper, you see in 2005, almost 1,200 companies had to restate their financial statements, meaning they made a mistake. They did something wrong. Either they discovered it, their accountants discovered it, or the SEC discovered it, and they had to go back and make a restatement. 15% of all companies that filed financial statements publicly had what was called an adverse report, meaning they had to disclose that they did not have an adequate control environment over their numbers. Now, PPG has had neither of those, and we don't intend to have them in the future as well. And I think one of the things you can take comfort in is I think we've recognized pretty much around the world for our clarity in financial reporting. Fortune magazine often lists PPG as one of the most admired chemical companies. In 2004, we were the most admired chemical company in both the world and in the U.S. A lot of magazines recognize us for the clarity of our financial reporting. And since 2001, every year we've won the Nicholson Award, which is given to the chemical company for the clearest and most transparent financials. So I think you can take a lot of comfort in that. So with that, let's check up, and glad to take questions.
Thanks, Bill. A few thoughts about asking questions. For those of the employees who are here in conference room 6 and 7, if you could just raise your hand and then wait until a microphone is available. Casey McCrory is our microphone person today. That'll help make sure that everybody who is listening in on the phone and on the webcast can hear your question as well. If you're sitting in one of the conference rooms at one of our remote sites, our AT&T operator will be unmuting those lines, and then in order to ask a question, you'll need to press *1 on your phone. And then for those who are listening or viewing the webcast, if you have to, or if you have a question, you can email that to askaquestion@ppg.com. I know, Chuck, that we had a few questions emailed in before the meeting, and you have a few of those that you wanted to go through as well.
Yes, maybe I can start with a couple of the questions that Bill and I can address, and then we certainly want to take some questions, especially from the remote locations, and test our technology. So we're going to try to go through a lot of these questions relatively quickly. The first one I had, it was a little longer question, but I think the punchline was, with our future looking brighter, what can PPG employees anticipate in terms of pay increases within the coming year? And I think, as many of you know, we have evolved over the last 10 years to be a pay-for-performance company. That means that there is an individual performance component, a business unit component, and a corporate component to our pay increases. And I think we've moved away from what was more traditionally sort of everyone got the same kinds of increase, and we've tried to put this variable pay component in so that you are really rewarded for the contributions that you and your business unit make. In the past year or two, as we've talked about today, we've seen probably also more variability in terms of the performance of some of our businesses, so that we've had in last year just a few businesses that far exceeded plan, a couple more made plan, but we had a number of businesses that really struggled, not only with plan, but in a couple of cases actually lost money. This year, I think so far we're having a very good year, and it's a little more balanced in terms of the contributions of all of the businesses. So I would expect, if these trends continue, that we should see a little more positive trend in terms of overall employee compensation, again based on these for performance criteria. The next question we had, and I'll give this one to Bill, but I'll read it. Many times in recent years, I have come across news stories which discussed companies eliminating their pension plans. How sound is PPG's pension plan, and can we expect this to continue to be a benefit for PPG employees?
As I think I mentioned in my comments, we're putting about $100 million in the next couple of weeks into the pension plan. And what the government does is they look very closely at pension plans, and if they're underfunded, they have required contributions that they expect you to make, and they also charge you a higher insurance rate for participants in your pension plan. For PPG, if with the investment we have in our pension plan, even if we don't earn a penny on it for the next couple of years, there's no requirement for us to put any money into our pension plan until at the very earliest 2008. We also are not charged a single penny in terms of any incremental insurance premiums for it. So we're very, very, very well funded. That being said, we spend about $150 million a year in terms of pension costs out of the pension plan, and that goes up each year. In 2005, which was not a bad return year, we earned about $140 million. So it is something we have to watch very, very closely, both the cash coming in and the cash going out. But so far, I think we've managed it very, very well.
Thanks, Bill. We had a couple of questions on labor relations here in North America. One, can you predict when and how the strike at Lake Charles will end? As many of you know, we've been on strike at Lake Charles for almost 3 months now. But I have to say that we have operated this plant since the first day at full production levels with record productivity and costs with the existing management and salaried professionals that are there. And I have to compliment all of them for continuing to supply and serve our customers, and have done an excellent job. Now, having said that, it is difficult for me to predict when, if or when the union will decide to return to work. Our intention is to continue to run this plant, and we will run it successfully. We will not, however, indefinitely operate this plant under the current circumstances. So we are now reviewing our options, and we could move to more permanent solutions for operating this plant in the near future. Two other questions regarding UAW activity. One is employees at Crestline recently voted in the union. To what do you attribute the union's win? I think we talked a little bit about the anxiety and the concern in several of our markets. Probably the market that has been most in crisis here in North America over the last several years is the automotive OEM market. We have the two largest American producers, General Motors and Ford, in financial distress. They have tried to then pressure their supplier community to reduce prices, give them more value, and this has created a tremendous amount of tension in the supply chain for automotive. We've seen a number of bankruptcies, and I think there is concern out there. But having said that, I am disappointed clearly in the results of the vote at Crestline. I think that it is an unnecessary step to bring in the UAW to represent those workers. And the important thing to remember is that that decision does not change what happens in the marketplace and with our customers. That is the critical element. There will not be one more piece of glass that we're able to sell as a result of that decision, or no customer will give us a price increase as a result of bringing in the UAW. So that we are still faced with the same challenges in that business unit, and we have to work together to find solutions to successfully supply these customers with our existing business unit assets and resources. And I do not think that the UAW brings anything to that equation, because the next question is, why is the UAW targeting PPG? Well, they're faced with some of the same problems that we've talked about at General Motors and at Chrysler and at Ford. They've seen their membership decline from 1.5 million members in the 70s to about 600,000 workers today that are represented by the UAW. That's almost 1 million members have left the rolls of the UAW. They do not have a history of creating or preserving jobs. And for us, we need to preserve our PPG jobs. We need to create jobs. And I think in this situation, I do not see, I can understand why the UAW is targeting us and any other healthy companies. We're probably one of the few companies that they're targeting that's other than their current membership, which are working for companies already in bankruptcy or close to bankruptcy. So I think that they're in a crisis, desperate. They're trying, I think, to branch out, find other companies, and I think in many cases over-promising to our employees and to others on what they can deliver. But the reality of the situation is that the marketplace and our customers determine who and how we supply them. One last question, and then we'll move to some of the questions either from the floor or remotely. And this is an interesting question. We seem to stay committed to businesses and markets that are no longer profitable, such as specialty chemicals and fiberglass. We have been hearing about plans to turn these businesses around for quite some time without any real results, specifically in fiberglass. What is planned to make these groups profitable and viable again? Can we realistically expect profitable results in these markets given current market conditions? Well, that's a pretty tough question. One that sometimes I get accused of making these kinds of questions in some of our strategy reviews. I think it's a good question, and those are two businesses that have struggled over the last few years with market conditions and some of these global factors. The competitors in China and India in specialty chemicals. This year we have turned a corner here in the second half, and we received an important order for Tamiflu, the Asian flu vaccine from Roche. So we are making progress, although next year and the following years, I think we have some challenges continuing in that business. In fiberglass, we have been working very hard, and I really have to compliment the team over the last couple of years. They've taken very dramatic steps to improve their productivity and cost position. I think we've made significant progress. We will be profitable and make plan this year in fiberglass, as we will in specialty chemicals, but we still have an awful lot of work to do. We can't stay and afford to stay patient, given what we discussed about the financial markets, and they're expecting short-term results. So we need to see continued meaningful progress from these two businesses, as well as some other businesses that are struggling right now. And if we don't get that kind of progress, we don't want to make, I think, short-term decisions here. We've never done that. These businesses have contributed in the past, but they have to continue to make this kind of progress, or we have to find some alternate strategies to create some shareholder value. So with that, Jack, I think that's the list of questions that we had initially, and why don't you start now, either remotely or from the floor?
Yeah, if there's anybody within the room here who has a question. Yeah, Casey, bring it over.
Anissa Flickinger with the construction market team, and in your presentation you mentioned the success of the construction market team as a cross-SBU initiative, and I have to agree, being part of that team. But since we've seen success there, are you looking to perhaps other cross-SBU initiatives to further expand growth in different business units?
I think the other example, we've had a couple of other examples, one in the automotive aftermarket where we brought together refinish, the automotive replacement glass business, and insurance and services, and I think we've seen some good synergies there that have developed, and that was actually a more formal structure because we actually put the three SBUs together under one executive, initially Gary Gowdy, now Rich Alexander. In the construction market team, it's more of a segment of each of those businesses, but not the entire SBU. We also have that example in aerospace where we took what had been the transparencies business, put it together with the sealants as well as the coatings businesses. So I think we've tried to capture some of the synergies in these other market areas. The one area, automotive OEM, we've tried to stay away a little bit from bringing glass and coatings together because, as we've talked with some of the desperate conditions that our customers are in there, they've tended to try and use that leverage against us. So we are operating those businesses somewhat separately, but in the other areas we're trying to capture the synergy opportunities that are available either formally through the organizational structure or trying to bring at least segments like the one that you're in together.
Okay, Rochelle, do we have any questions from the remote locations?
As a reminder for those people attending on the phone lines, if you'd like to ask a question, please press *1 at this time. We will go to the line of Kathy Behren in Delaware, Ohio. Please go ahead.
Hi, thank you. Would you comment on the recent acquisition of Amerion and Protec and the impact to the existing SBUs such as refinish?
Well, in the case of Amerion, Amerion is a supplier of marine and protective coatings. It is, I would say, somewhat distinct from the refinish business, although refinish sells a few marine products, and I would think that there would be a small impact. The more importantly, we've had a high-performance coatings sub-segment, if you will, within our architectural coatings business. So now there is a little complexity that we've introduced here because we're going to bring the high-performance coatings, protective coatings from architectural and put it together with Amerion and really try to go to market with our existing distribution in architectural and also continue to service some of the direct customers from Amerion. So it is, I think, an excellent opportunity for us to grow, but we're having to, I think, work a little harder on the integration, especially with architectural for Amerion. On the Protec side in Australia, we have a great refinish business in Australia, but it's targeted more at the high-end collision market. the Protec company is targeted more at the lower end and the fleet segment. So we don't think that we're going to really have a competitive issues with our customers and distributors. And in fact, this should complement our product offering, and we should be able now to reach both the high-end collision segment and also our distributors, lower end value segment, and also the fleet opportunity. So I think the integration issues will be minimal, and it is, I think, an excellent opportunity for refinish in the Australian market.
Okay, Chuck, we have a question from the email box. Given the impact that natural gas has had on the profitability of the company, what activities is PPG engaged in to hedge against rising gas prices?
We have been actively hedging natural gas for, I would say, at least the past 10 years. It is something that we have, I think, a very disciplined approach. Bill and I are involved with Kathleen McGuire, who's here today, who's our Vice President of Purchasing and Distribution. We communicate on a frequent basis. We watch the markets. Unfortunately, we had a very good hedge position a couple of years ago, but as you've seen with that escalation, it's very difficult once the prices get to a certain level to hedge further. So I think we're now at a point where we're not hedged out into the future as much as we would like. We are fairly adequately hedged for the rest of this year, but we haven't seen the long-term prices come down. Supply-demand balance is actually, we think, pretty good, but because of risk assessments or speculation in the marketplace, we see the longer-term trends for natural gas still quite high in the prices. So we haven't been adequately hedged in terms of what Bill and Kathy and I would like to see. So right now, we can only tell you that this is something that we watch daily. We communicate. I just talked to Kathy yesterday about what was happening in the market and the opportunities. So certainly it is a risk that we would like to control better, but we haven't been in a good position for the future years to adequately hedge as we'd like. But for the rest of this year, we are fairly well hedged now. I would say probably upwards of 75% for the rest of the year. So we've locked in what has been this recent favorable trend in any event.
Okay, can we take another question from the floor here, or?
Nate. Oh.
Based on your presentation, it's obvious that we're making some good results on acquisitions. What about the thought of a large acquisition, say 10% of our revenue base or greater? Where's the thought on that?
We have looked at, and we continue to look at opportunities to make, and I think, Nate, you're correct in saying these have been more of the bolt-on acquisitions, smaller, that we can fit in or tuck into our existing business units. We have looked at opportunities to make a bigger acquisition. I think, as Bill would indicate, we have a strong balance sheet. We have the flexibility to do that, but in many cases, the targets for us right now we are not as comfortable with, either because we don't think that the target companies are as attractive, or there may be antitrust risk. But having said that, there are still a couple of opportunities that may develop over the next year or two that would allow us, I think, to achieve our goals and to make, I think, a bigger commitment in terms of acquisition. So we're actively talking about that. The board has supported not only the smaller acquisitions, but they've said that if we're successful, they're very comfortable in continuing to support us even with bigger acquisitions.
Chuck, here's a question from the email box. Why are R&D expenses declining as a percentage of revenues over the past 3 years? According to the question here, it was 3.3% in 2003, 3.2% in 2004, and 3.0% in 2005.
Well, we have never set a firm target as a percent of sales for our R&D efforts. We think that we're spending at a very important level, certainly higher than any of our coatings competitors, as an example. So we have more of a commitment to R&D than almost anyone in our market space. And as you've seen our sales growth over the last couple of years, some of this is also coming from price increases that we've been able to obtain, and we're also growing in a couple of segments like architectural coatings that traditionally we haven't had that same level of R&D commitment. And in the business unit within coatings, as an example, where we have traditionally spent the most money as a percent of sales, and this would be automotive OEM coatings, we're seeing that growth has matured, so that I think to just look at that percentage as a percentage to our total sales is probably misleading. And if you look at the segments where we really feel that we can make a difference to drive innovation, we think that we're spending certainly at levels that will allow us to successfully introduce new products and take advantage of our R&D.
Okay. Can we take another question from the room? No?
Can you comment a little bit about the stock price, maybe more specifically about the Challenge 2000 stock option and how confident you are that we could exercise those options?
I'm going to turn this one not over to my predecessor, but I'm going to turn this one over to Bill Hernandez. Bill, do you want to comment on?
Yeah, it's hard to prognosticate what the stock price will be. PPG stock price often was classified as an early cyclical stock, meaning when they see the cycle start turning down, it puts more pressure on it. So if you read what most of the analysts have out there for PPG, they say doing a great job, good management team, good products, and all that, but they're concerned over what they've seen, as I mentioned, the ChlorAlkali cycle, and they see what's happened in glass and fiberglass. That being said, several of them have what they call target prices, where they think at that level, PPG, you should sell PPG, the ones who have, and some of the analysts have us roughly $70 to $74 at that level, saying that's the kind of price that PPG could be fairly traded at. Any higher than that, you should sell. So we may get up to that, but it's very hard to estimate where the future will be. A lot of it's going to occur if people start seeing a recession happening. That puts a lot of pressure on us and a lot of other companies in that cycle. If we continue growing the way we have, people see a continuation. They see a moderation of the energy prices, and they see a continuation of ChlorAlkali. So, as I showed you, there's a kind of a gradual decline, then a rapid decline. They think that holds up. Then you may be able to exercise your grant.
We're kind of running out of time, so I'll just ask one more question. Can you give us an update on PPG's efforts to win the war for talent?
Well, I think we have continued to aggressively try to not only develop and upgrade the talent that is already within the company, but also to hire and recruit people that will clearly contribute to our success in the future. Actually, one of the biggest concerns that we have is how do we develop talent in these emerging regions? And with all the growth that we're experiencing in Asia and Eastern Europe, away from our traditional resources and bases of support, I think this is the biggest challenge that we have as managers, or what Budweiser and others in human resources would tell you that they are confident about. So they're trying to bring associates in China or in Poland or in Russia, where we are really seeing growth, to bring them into our culture, to train them in our values, and to help with their training of our products. Many of them are very highly qualified, but we still have to teach chemical engineers or chemists formulations or chemical or coatings operations. So there's still a lot of work to do, and I would say the war for talent for us, probably the toughest battle we have today is in the emerging regions. How are we able to project our company, all the values, all the learnings, all this institutional knowledge that we have and that has made us so successful in in North America or Western Europe, how do we translate this effectively to all of these new associates? And I think all of you will have a role in this. We have to help these people learn, help them understand how PPG operates, and I think this will be a true test for us because it is critical that we are successful in these emerging regions with this growth.
Thank you very much. Appreciate your time.
Okay, thank you, and thank all of you. It's been a wonderful first experience for us. We hope that you've enjoyed it, and I'm looking forward to more of these types of global meetings in the future.